Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Thursday, February 24, 2011. It's 11:30 a.m. Eastern Standard Time in the U.S., 4:30 p.m. in London. In Mexico City, it's 10:30 a.m. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. We have some very interesting news just came in. Toyota is recalling 2.2 million vehicles in the U.S. This is not a joke, to address accelerator pedals that could become entrapped in floor mats or jammed in carpeting. Toyota has now recalled more than 14 vehicles globally over safety problems since 2009. You'll recall that just last week, American regulators said that the electronic flaws were not to blame for reports of the unintended acceleration, and that in fact the problem was due to problems with the floor mats. Well, I guess now that that has been determined, they decided to go ahead and bring them all back and get them fixed. We'll go to our main news. We start with New Zealand. Scott Vincent has a good article in the Insurance Day today. He says that a large percentage of the multi-billion-dollar loss from this week's earthquake in Christchurch is going to be passed on to the international reinsurance community. Of course, this is only the first quarter of the year, so the annual catastrophe budget is going to really be hit hard. Here's why. Local New Zealand insurers have in the past 24 hours published their initial estimates of their costs of this event. Both Suncor and Insurance Australia Group, IAG, have indicated that their reinsurance programs are going to absorb most of the cost. Suncor said that its reinsurance program had limited exposure to about $45 million US for the event. So that means that Suncor would have to pay $45 million out of pocket. Reinsurance picks up after that. IAG said that they have to pay up to $40 million out of pocket. Reinsurance picks up after that. QBE, the other big player down there, has not yet indicated any announcement about their reinsurance program. Here's the big banana. The New Zealand Earthquake Commission, the country's state-backed cat pool, will face a big chunk with the primary impact, with much of this being passed on to reinsurers in Bermuda, London, and Europe. The Commission retains the first $1.5 billion of any event. After that, reinsurance kicks in. What's the total? Could be as high as $12 billion, an expected industry cost. The low is about $3.5 billion. Where is it all going to go? Well, Bermudian reinsurers are expected to face the largest share of the losses. Commercial claims are likely to make up a significantly larger chunk of losses from the earthquake in September. Early modeled estimates indicate that the range of the total loss, as I said, could be between $3.5 and $12 billion. Analysts at Jefferies International said last September's quake generally saw Bermuda reinsurers more exposed than Lloyd's, and they said that that's likely to continue for this event. Here are some specifics. Based on a $4 to $5 billion loss for the event, based on models from AIR, Jefferies indicated that they believe they can see a 340 million euro hit for Munich Re, 230 million US for Swiss Re, and 160 million for Amlin. They further believe that Hiscox will be hit with 37 million pounds, Catlin $50 million, and Zurich $100 million. I don't know why we have different denominations there in currencies, but that's how they came out. Jeffrey said that firms such as Swiss Re, Munich, Amlin, and Hiscox are now more than 50% their anticipated catastrophe burdens for 2011. Whoa, we better hope that there are no hurricanes in the U.S. this year. This is sort of good news for the primary companies. The head of one of Australia's biggest reinsurers said today that the earthquake this week was a separate event from the one that occurred 5 months ago in September. Swiss Re Australia New Zealand Managing Director Mark Sankovics said yesterday that extensive tests would be needed over the next few months before a definitive ruling would be made, but he said it would be our early view that it would be a separate event, given that there were different timelines and different fault lines. Well, it was a 5-month period between the two. Mr. Sankovics went on to say that there are still many variables, however, to look at before a final decision could be arrived at, including elements such as liquefaction of the soil. He said that has a profound effect on buildings. It's an effect known to us reinsurers, so we have to look at things like that. So should the two major reinsurers in Australia, Swiss Re and Munich, make a final decision that the quake this week was a separate event, that's good news for IAG and Suncor and QBE. This means that their losses are going to be capped. Actually, it's going to be negative news it's going to be good news from the reinsurance perspective. That means that IAG and Suncor are going to have to pay $40 million 2 times, but meanwhile, they're going to have that much more access to the reinsurance. So it's sort of 6 in one, half a dozen of the other. Where's all this leading? Well, in Sydney, Australia yesterday, board member of Munich Re was present, and he said that he believes this is going to lead to finally higher upward movements on reinsurance pricing. The catastrophe has put strain on the New Zealand-Australia region, which is the location of 4 of the world's costliest natural perils in 2010. That's the 2 earthquakes and the 2 floods. Mike Mitchell, managing director at Swiss Re Asia, says we do envision an impact on the insurance industry as a result of the compounded effect of these disasters. He said we're probably going to begin to see it on the upcoming April 1 and July 1 renewals. Thank God. We had that interview with Toby Esser earlier this week, and Esser said that already, less than a year after the Chilean earthquake, they've begun to see premium prices heading downward for South American earthquake risk. Our friend Bernard Size in Belgium is moving on. He's retiring. Aon Benfield has appointed Jean-Francois Wallin as CEO of its Brussels office effective March 2011. Wallin, who currently heads Aon Benfield's analytics, Benelux, replaces Bernard, who's going to retire in March. Meanwhile, Jürgen Wielands will assume the role of head of analytics for Benelux. RSA has recorded a post-tax gain of £355 million for 2010. It's down 15% from the $419 million booked last year in 2009. Based on net written premiums about £7.5 billion, which is an increase. RSA, of course, was hit pretty badly by the Chilean quake and the bad weather in the United Kingdom at the end of 2010. And from Bermuda, Partner Re announced that Brian Secret has been appointed head of its CAT business unit. Secret is currently Chief Underwriting Officer and Deputy Head of Catastrophe. He's going to become responsible for Partner Re's worldwide CAT reinsurance business and report to the CEO of Partner Re Global, Emmanuel Clark. The stock market in New York is down only 21 points right now. It's a change from where it's been the past 2 days. We'll go to a word from our sponsors and come back with the rest of the news. Well, the price of oil has reached about $110 a barrel. Of course, that's due to our next story, the problems in Libya. But before we get to that, the Saudi Arabian oil people have just announced that they will make up any shortfall which could be caused to the global oil market by cutbacks in production in Libya. So this could, in fact, end up with a stabilizing influence on oil. Remember, the one thing the Saudis always do is make sure that demand is not outweighed by too high a price. They don't want that demand to go down. God forbid people find alternative means of energy production. And all of a sudden, all the oil in the ground would not be worth as much. Speaking of Libya, here we go. Here's the daily update. I shouldn't be cavalier about it. Thousands of people are being killed. Most of the country is apparently in the control of the protesters. Gaddafi has alternately been reported either holed up in a barracks in downtown Tripoli. Preposterously, this is something I'm going to quote. This is from the New York Times right now. He made an impassioned 30-minute phone call to a Libyan radio station about an hour ago. He appeared particularly incensed today about the protest. In his rambling discourse, he blamed the Libyan uprising on Osama bin Laden, saying bin Laden had drugged his people, giving them hallucinogenic pills in their coffee with milk, like Nescafe. That's what he said. He went on to say then, these people, Al-Qaeda, took your sons away, gave them drugs, and let them die, and now they're launching a campaign over cell phones against your sons, telling them not to obey me, and they're destroying their country. I think he's just about had it. Today might be the day. The American economy has some positive news, and another sign that the U.S. job market is slowly recovering. The number of Americans filing first-time claims for unemployment benefits dipped below the magic 400,000 mark last week. 391,000 people filed for jobless claims in the week ending February 19th. That was much better than the 410,000 claims that had been expected by analysts. Here's a heartening story from Christopher Monroe in the Insurance Day. It comes from our friends Fitch Ratings. They say that the insurance industry will not feel the positive effects of Solvency II until at least 10 years have passed. Fitch said that this is because of Omnibus II, which is the implementation guideline to Solvency II, published last month. It sets out ways in which the industry will move from its current Solvency I directive to Solvency II. Of greatest interest to insurers will be that they're going to have until 2023 to actually fully comply with the full scheme of the regulatory regime. This obviously brings very good news to small insurers who were complaining about the difficulty of having to comply by the end of 2013. Also, it's news that Aon Benfield has picked up on. They've begun to be publicly quoted saying that we must take a much more slow approach to Solvency II compliance. Here's a story from the Daily Telegraph today. The UK's aging population and huge debt have propelled it into the top 10 countries in the world threatened by unsustainable public finances. Britain is now one of 10 nations rated as extreme risk in the Fiscal Risk Index compiled by the analyst Maplecroft. Britain was ranked 10th in the list of 163 countries, calculating that it was at that position because of its high public spending on health and pensions, massive borrowing, and shrinking work population. Italy won the list, number one. Belgium, France, Sweden, Germany, Hungary, Denmark, and Austria are next. Japan was 9th, Finland 11th, and Greece 12th. The reason the UK jumped? Their GDP, their government debt, I should say, the proportion of GDP of the government debt has jumped from 43% in 2006 up to 77% last year. They only have well, this is actually surprising. The relatively high number of people over 65 is going to jump up to about 9% at the end of this year and 28% by the end of the decade. It's forecast that by the year 2050, there'll be 38 old people, i.e. over 65, for every 100 people working in Britain. That's up from 25 now. That's a lot of old people. And I guess it's one of those combination of free health care, excellent benefits, and unfortunately a shrinking economy. It's a global problem. I don't know what's going to happen. Stock market down about 27 now. If we have any breaking news, we'll come back and tell you. In the meantime, thank you for watching, and we'll see you tomorrow.